Donald Trump's recent trade threats have sent unprecedented waves of uncertainty through the global financial system, causing investors to rethink strategies and hedge against sudden market movements that could impact portfolios in unpredictable ways. The US dollar has responded sharply to these developments, reflecting the immediate anxiety of traders and economists alike as they attempt to gauge the long-term effects of potential trade conflicts on both domestic and international economies. Markets are experiencing heightened volatility as currency traders adjust positions in response to each new statement from the White House, indicating that confidence in predictable economic policies is eroding rapidly under political pressures. Analysts have highlighted that Trump's approach to tariffs and trade negotiations is unlike previous administrations, creating unique challenges for multinational corporations that rely on stable international agreements to manage supply chains efficiently. Investors are increasingly focused on sectors most likely to be affected by tariffs, including manufacturing, technology, and agriculture, as these areas are highly sensitive to shifts in trade policy and currency valuation fluctuations. Global central banks are monitoring these developments closely, weighing the potential need for intervention if currency instability threatens economic growth, inflation control, or cross-border capital flows. The unpredictability of Trump's statements has added an extra layer of complexity, with market participants needing to react in real time to any hint of escalation or de-escalation in trade rhetoric. Currency traders have observed that the dollar's strength is now more reactive to political developments than traditional economic indicators, showing how closely politics and finance are intertwined in today's global economy. The ripple effects of potential trade wars extend beyond the US, impacting major economies such as China, the European Union, and Japan, all of which are critical players in international commerce and currency markets. Commodity prices, particularly oil and metals, are also showing increased sensitivity to trade tensions, as fluctuations in currency value directly influence import costs, export competitiveness, and global supply-demand balances. Investor sentiment has shifted toward risk-averse strategies, with increased demand for safe haven assets such as gold and government bonds as protection against sudden market swings induced by trade threats. Equity markets have shown sharp reactions to news of tariffs, with high-profile technology and manufacturing stocks experiencing notable price swings based on perceived exposure to trade conflicts. Financial analysts emphasize that businesses with global supply chains must reassess contracts, sourcing strategies, and pricing to mitigate the impact of potential tariffs and currency fluctuations. The U.S. Federal Reserve is under scrutiny as investors speculate whether it will adjust monetary policy to counteract trade-induced economic volatility and maintain stability in the financial system. Emerging markets are particularly vulnerable to these developments, as currency volatility can create severe challenges for debt repayment, foreign investment, and overall economic growth. The interplay between trade policy and currency strength has become more pronounced, with the dollar's movements directly influencing the competitiveness of U.S. exports and imports on a global scale. Investor behavior suggests a growing reliance on hedging strategies, including derivatives and options, to shield portfolios from the unpredictable consequences of escalating trade tensions. Economic commentators have warned that prolonged uncertainty could depress business investment, slow hiring, and reduce consumer confidence, potentially affecting the broader economic outlook for the United States. Global supply chains are under intense pressure, as companies reconsider sourcing from countries affected by tariffs or geopolitical friction, leading to potential disruptions in production schedules and costs. Traders are now monitoring not only official statements but also offhand comments from political leaders, as even minor remarks can trigger dramatic short-term movements in currency and equity markets. The volatility in the dollar has prompted discussions among economists about long-term consequences for inflation, interest rates, and the purchasing power of U.S. consumers. Investors are comparing current conditions to past periods of trade tension, but many agree that the speed and unpredictability of policy announcements make this era unique in terms of market uncertainty. Risk management strategies have evolved to include more frequent scenario planning, with businesses modeling multiple outcomes to better prepare for sudden policy changes or currency swings. The interconnection of global markets means that instability in the dollar can have cascading effects on international trade, investment flows, and even geopolitical relationships between nations. Financial media outlets are closely following each development, amplifying market reactions as headlines about trade disputes often drive investor sentiment and influence short-term trading behavior. Corporate boards are convening emergency meetings to assess potential exposure to tariffs and the associated financial implications for upcoming fiscal quarters, highlighting the pervasive impact of trade policy uncertainty. Investors have shifted some capital to alternative currencies and emerging market assets that may benefit from dollar fluctuations, seeking to diversify risk in an increasingly volatile global environment. Trade-dependent sectors are closely monitoring import and export data, as sudden changes in tariff policy can dramatically affect supply costs and profit margins almost immediately. Analysts note that even rumors of trade disputes can create market turbulence, as speculation alone is sufficient to trigger significant movements in currency and equity prices. Economic forecasters are struggling to provide accurate projections, given that traditional models often assume a degree of policy stability that is currently absent under unpredictable trade rhetoric. Corporate earnings guidance has become more conservative, as executives account for potential cost increases from tariffs and the volatility of the dollar in their financial planning. The energy sector is particularly sensitive to currency shifts, with oil and gas prices reacting not only to supply and demand fundamentals but also to trade-induced uncertainty in key markets. Investors are increasingly viewing the situation as a test of global economic resilience, observing how interconnected markets respond to rapid political and policy-driven shocks. Financial risk analysts emphasize the importance of liquidity, as sudden dollar movements can create cash flow pressures for companies reliant on international transactions. Supply chain managers are reconsidering logistics strategies, including inventory management and shipping routes, to mitigate the potential effects of tariffs and currency volatility. The agricultural sector faces particular challenges, as farmers and exporters rely heavily on stable currency values and predictable trade agreements to maintain profitability. Currency markets have seen spikes in trading volumes, reflecting the heightened activity of hedge funds, institutional investors, and day traders responding to rapid developments in trade policy. The technology sector, which relies on global supply chains and overseas manufacturing, is particularly exposed to the financial impact of tariffs and fluctuating currency values. Investor surveys indicate growing concern about the durability of long-term trade agreements, raising questions about the future of multilateral trade frameworks and international cooperation. The financial community is closely watching negotiations with China, the European Union, and other key trading partners, as these discussions will heavily influence the trajectory of the dollar. Speculation about retaliatory tariffs and countermeasures from other countries adds an additional layer of complexity to currency and equity markets, creating heightened risk for global investors. Economists warn that consumer prices could rise if tariffs increase import costs, potentially impacting spending patterns and overall economic growth in the United States. Bond markets are also reacting, with investors adjusting positions based on perceived risks to the U.S. economy and the potential need for intervention by the Federal Reserve. The interplay between fiscal policy, trade strategy, and currency valuation has become a focal point for investors, as each component can amplify market reactions to policy announcements. Market sentiment has become increasingly reactive, with short-term trading driven more by geopolitical developments than traditional economic indicators like employment or GDP growth. Corporate mergers and acquisitions are being reassessed in light of potential tariff implications, as cross-border transactions may become more expensive or riskier under volatile currency conditions. Investor confidence in long-term growth is being tested, as uncertainty in trade policy creates challenges for capital allocation, planning, and strategic decision-making. The volatility of the dollar has implications for international debt, with borrowing costs and repayment obligations shifting as currency values fluctuate in response to trade threats. Financial institutions are reviewing exposure to trade-sensitive sectors, emphasizing risk mitigation and diversified asset allocation to withstand potential market shocks. Investors are weighing the potential for a flight to safety, moving capital into U.S. Treasuries, precious metals, and other instruments that traditionally perform well in periods of uncertainty. Global trade dynamics are evolving rapidly, with policymakers and business leaders adjusting strategies to account for both short-term disruptions and longer-term structural shifts in international commerce. Analysts suggest that even if immediate trade conflicts subside, the lingering effects on investor confidence and currency stability could persist for months or even years. Corporate finance teams are increasingly scenario planning for adverse currency movements, hedging against potential losses in anticipation of unpredictable trade developments. The ongoing uncertainty underscores the interconnectedness of modern financial markets, demonstrating how policy decisions in one country can have cascading effects across the global economy. Market observers note that rapid changes in investor behavior, driven by trade rhetoric, highlight the importance of agility and responsiveness in navigating volatile financial landscapes. The combination of political unpredictability, trade negotiations, and currency volatility creates a complex environment where both short-term trading and long-term planning require unprecedented levels of attention and foresight. Investors are closely monitoring not only economic indicators but also diplomatic communications, as signals from negotiations can trigger immediate shifts in the dollar and global markets. The current situation is a reminder of the delicate balance between domestic policy objectives and global economic stability, with the dollar serving as a central barometer of market confidence. As trade tensions continue, the outlook for the US dollar remains uncertain, with market participants bracing for further volatility and potential disruptions to global trade flows. Experts emphasize that maintaining flexibility, closely monitoring developments, and preparing for multiple scenarios are essential strategies for navigating the ongoing turbulence in currency markets. Financial commentators warn that prolonged trade uncertainty could affect long-term investment, economic growth, and the stability of international financial systems, underscoring the importance of measured policy responses. The dollar's performance in the coming months will likely reflect the combined effects of trade negotiations, policy decisions, investor sentiment, and global economic conditions, creating a highly dynamic financial landscape. Corporations, investors, and policymakers alike must remain vigilant as the interplay between trade threats and currency movements continues to evolve, with each development carrying potentially significant consequences. Global markets are watching closely, understanding that the actions of one nation, particularly the United States, can ripple across economies, affecting everything from investment flows to consumer prices worldwide. The uncertainty surrounding trade policy highlights the critical role of strategic planning, risk management, and adaptability in maintaining stability and confidence in an interconnected global economy. Overall, Trump's trade threats have not only introduced immediate volatility into the dollar but have also raised broader questions about the resilience of financial markets in the face of unpredictable political decisions. Investors and corporations are now operating in an environment where agility, foresight, and a keen understanding of geopolitical developments are essential to managing risk and ensuring continued financial stability. The long-term impact of these developments will depend on the resolution of trade disputes, the reactions of global economic partners, and the ability of markets to absorb shocks without triggering widespread instability. Market participants are increasingly aware that the dollar's value is influenced by a complex interplay of political, economic, and strategic factors, highlighting the importance of vigilance and informed decision-making. The ongoing turbulence underscores a broader lesson for investors. In a world where political unpredictability can directly affect financial markets, proactive risk management is more critical than ever. Even as negotiations progress, the dollar's performance will remain a key indicator of investor sentiment, reflecting confidence in trade policies, economic fundamentals, and the stability of international commerce. The current volatility serves as a reminder that currency markets are highly sensitive to policy announcements, with even minor signals capable of triggering significant financial reactions. Strategic planning, scenario analysis, and constant monitoring have become indispensable tools for businesses and investors seeking to navigate an era of unprecedented uncertainty and rapid market shifts. Global financial institutions are adapting to the new reality, recognizing that trade policy, political rhetoric, and currency fluctuations are deeply intertwined and require coordinated strategies to manage risk effectively. The ongoing fluctuations in the dollar emphasize the importance of remaining informed, responsive, and adaptable, as market conditions can change rapidly in response to both domestic and international developments. Financial experts suggest that businesses should maintain a long-term perspective while preparing for short-term shocks, balancing strategic growth objectives with defensive measures against volatility. Trade tensions and currency instability will likely remain central themes in global markets, influencing investment decisions, corporate strategies, and economic forecasts for the foreseeable future. The cumulative effect of these dynamics highlights the interconnected nature of global finance, where the actions of policymakers, investors, and multinational corporations collectively shape market outcomes. Investors, corporations, and policymakers must now operate with heightened awareness, understanding that the interplay between trade disputes and currency movements will continue to drive volatility and shape economic trends worldwide. The resilience of global markets will be tested in the coming months as trade negotiations unfold, with the dollar serving as a barometer for both risk appetite and confidence in economic stability. Ultimately, navigating this era of uncertainty requires vigilance, adaptability, and strategic foresight, as political developments, trade disputes, and currency fluctuations converge to create a highly dynamic financial environment. Trump's trade threats have underscored the fragility of global financial systems, demonstrating that even a single nation's policies can reverberate through currencies, commodities, equities, and international trade networks. The dollar's trajectory in the months ahead will depend on the resolution of trade tensions, investor reactions, and broader economic conditions, requiring all market participants to remain alert and prepared. Financial markets are entering a period defined by unpredictability, where careful analysis, rapid response, and diversified strategies will be key to mitigating risk and capitalizing on opportunities. Even as temporary stability returns, the lessons of recent volatility will persist, reinforcing the importance of proactive planning, scenario modeling, and strategic flexibility in an era of political and economic uncertainty. Global investors are learning that currency markets are no longer influenced solely by economic fundamentals, but also by geopolitical considerations, policy announcements, and the unpredictability of political leadership decisions. The heightened volatility in the dollar has far-reaching implications for trade, investment, and economic confidence, underscoring the need for strategic decision-making grounded in both data and scenario planning. Trump's trade threats have reshaped market dynamics, compelling investors and corporations to navigate a landscape where uncertainty, rapid fluctuations, and political developments are inseparable from financial strategy. Financial observers conclude that resilience, adaptability, and continuous monitoring will remain essential as global markets respond to evolving trade policies, currency movements, and investor sentiment. The interplay between trade rhetoric, currency volatility, and global economic trends underscores the complex environment in which investors and policymakers must operate to maintain stability and confidence. The dollar's performance continues to serve as a central measure of market confidence, reflecting the cumulative effects of political decisions, economic indicators, and global investor sentiment in an unpredictable era. International markets are likely to remain on edge, as each development in trade policy or political rhetoric can trigger immediate reactions in currency values, equity prices, and investment flows. The enduring lesson for investors is clear: in a world of interconnected markets, political uncertainty can translate rapidly into financial volatility, requiring vigilance, foresight, and adaptive strategies. Even as trade disputes evolve, the dollar remains a critical barometer for global economic stability, highlighting the interdependence of policy decisions, investor confidence, and international commerce. Global financial actors are learning to navigate an environment where traditional economic indicators are only part of the picture, with political unpredictability now exerting equal influence on market outcomes. Market participants must remain agile, informed, and prepared for volatility, recognizing that the dynamics of trade policy, currency fluctuations, and investor sentiment are deeply intertwined in shaping financial realities. The current period of uncertainty underscores the importance of comprehensive risk management, scenario planning, and strategic foresight to maintain stability in an increasingly unpredictable global economy.